So what happened this time with unemployment refusing to budge was bizarre. And until 3 or 4 months ago, I was still convinced the other shoe would drop. I was still convinced we would see rapid increases in unemployment. All of a sudden, the dam would break. No such thing has happened. Don't raise your rents, but raise your fees. I think that it's better for you to raise your fees than to raise your rents at this point in time, or maybe raise your rents less than you're thinking. So that buys you occupancy. Don't be very aggressive. 2024 is not a year to make money. 2024 is a year to get through. A lot of the people that know what they're doing is actually freezing projects. So if you're new, you haven't done a bunch of opportunity zone projects, this may not be the best time to do it. Now, if you're, far down the line, that's different. If you started construction, if you gotten your loan, that's different. Obviously, at this point, hang on for dear life because it's going to be very challenging.
And today's our guest speaker, Neal Bawa from Grow Capitals. Welcome back, Neal. You came to this podcast, episode 280, and coming back. Thank you very much. Really appreciate it.
Well, I'm glad to be back, and thanks for having me back. Excited to be here.
Yeah, sure. A little bit about Neal. Neal Bawa, known as the Mad Scientist of Multifamily. By leveraging his decades of data science experience, he has been able to identify high growth markets and build a highly profitable portfolio of 1 billion, like 30 plus projects, more than 10 states. So with that, Neil, you want to add anything to your background?
No, I'm, a geeky person that loves to look at numbers and everything. When I take a walk in the morning, I'm looking at numbers in the pavement and the trees. And so my goal is to reduce everything I see around me, news, distress, good news, down to the numbers. And sometimes that works for me, and sometimes I fail at it.
Sure. Yeah. Thank you. So from your perspective, what are the top reasons for distressed properties like last 2 years, especially multifamily space? How exactly we can avoid, down the line?
Well, I think the big lesson to be learned here is that everyone in the industry, including myself, so I'm no different from anybody else, had sort of forgotten just how strong of a correlation there is between cap rates and interest rates, right? So interest rates go up, cap rates go down. That correlation has always been known, but what had happened is in the 2018-19 cycle when the Federal Reserve raised rates, and they only raised them 3 times, so it was at quarter points each, so it was really 0.75. So compared to 500 basis points, 0.75 looks like very small. And so what happened is at that point of time, we didn't see any change in cap rates. In fact, they kept going down. And so I think if the Fed had kept raising at that particular point in that cycle, we would have seen cap rates change. But because it didn't happen, there was this, I think, laziness around, the way cap rates work and the consequences of those cap rates. The other piece of it is that there was this feeling that bridge lending works in all environments, even in an environment where, fixed rates are 3% or even lower, right? A lot of multifamilies have 3% fixed rate, 3.5%. So they had the opportunity to go perm, and people didn't take those opportunities because there was this feeling of, well, low bridge rates will be around forever, blah, 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 right? This is the new reality. So now we've come to basically everyone has reset to the standard position of everything moves in cycles, things go up, things go down, then they go back up, they go back down. And that's going to happen to multifamily. It's going to happen to our cap rates. It's going to happen to interest rates. And keep in mind that all of the things that are happening to our world, the fact that we are now in the fourth turning, if you don't know what that is, Google, look it up. We're in the fourth turning. That means that every successive year will be more volatile. So I do expect that in the next 5 years, we will see inflation spike again. I have no idea what will cause that spike. I definitely know it won't be something like COVID. It'll be something completely different, but it will cause a spike as well because our economies are becoming more and more fragile. So there will be, interest rate spike. There'll also be an interest rate drop because there could be an event like COVID. COVID took rates to zero. Something like COVID will come along in the next 5 or 6 years. So there'll both be opportunities for us when rates drop and distress when rates go up. Bottom line, people have learned two big lessons. Cap rates can go up, and bridge loans are not always the best. And an entire community of people has learned that lesson together because the Jobs Act in 2013 led to crowdfunding in 2014 and created really the syndication industry. Sure, there were a few people around, like my friend Michael Anderson had been doing it, for 20 years. He's retired now. But it was a very, very, very small number of people, maybe a few hundred. And now there's, 10,000, 20,000. Those are numbers that I hear in terms of syndicators. So the entire industry was created since 2014 and no one had seen a down cycle. And so the industry basically is going through a maturation process. And as a result, I think that we will be better, when it comes to the next distress. But as you mentioned, 2024 is still a distress year. So we're not done with the distress at this point in time. Nobody's properties are fully safe. And so I expect that the distress will ebb by the end of this year. And we can talk more about that. But the reasoning was people, didn't believe in these two things that I just mentioned. And that really led to these challenges. I can tell you that people that had been through cycles, especially larger companies with 100,000 units, a much bigger portion of their portfolio was perm and a much smaller portfolio was bridge, which thank God that happened because otherwise the entire industry would have been distressed. As it happens, the vast majority of these 2,500 properties that could be in distress or are in distress are new syndicators, the vast majority, right? Whereas the industry has, tens of thousands or hundreds of thousands of properties, and the vast majority of those are not in distress.
Thank you for sharing that. Even bridge also, there are some operators who have purchased rate cap, they're able to navigate positively, right? So who are not purchased
To some extent, right? I still think that, obviously buying rate caps is a best practice, but rate caps, unfortunately, most of the people who bought rate caps didn't buy them for long enough, right? So very few people bought 3-year rate caps, people bought 2-year rate caps. And what they really needed to do was to at least buy 3-year rate caps. So that's another learning. Hey, rate caps are great. And hey, in most cases, if rate caps are cheap, and by the way, when we were buying them 2 years ago, they were cheap, it makes sense to at least add in a third year. So that way you've got some insurance. So once again, this is a maturation process for the industry where everyone's going to mature and think better and be better. And I think that that's going to be better for investors in the next cycle, but we still have to fight through this cycle.
Yeah, thank you again. So will we see a lot of distress in 2024?
So the answer is yes and no. So consumers of, this particular podcast are likely to see a large amount of distress, right? So people that I talk with, conferences that I go to will see a large amount of distress. But the multifamily industry will not see a large amount of distress. So one of the pieces of math that I'm well known for is there's 19.6 million apartment units in the United States. Let's just call them 20 million, just for easy math.
Yeah.
And let's assume that the average building is 200 units. They're not, right? They're smaller. But just for math again, 200 units, right? So that means that if there's 20 million apartment units and each property is 200 units, we're looking at 100,000 properties, right? The total number of properties that are distressed in 2024 are roughly 2,500. I've also heard the number 3,000. So let's use the higher number. 3,000 properties are distressed. Okay. Let's assume that 100% of those properties are going to go back to the bank. Okay. Not going to happen because there are ways out for many of those, including kicking the can down the road until cap rates, improve in 2025. So some will be able to kick the can down the road. Some will receive help from their banks. But let's assume no bank ever helps. Nobody's ever able to kick the can down the road. Well, that means that 3% of the multifamily industry is in distress. So from an industry perspective, you have to realize syndicators and syndication audiences live in the same echo bubbles that Democrats and Republicans live in. Democrats only hear about all the bad things about Republicans. Republicans only hear the bad things about Democrats. In the same way, syndication people basically don't have any access to the larger multifamily community, which is comprised of a bunch of different groups. There are individuals that are holding onto properties for a long time and usually have permanent debt. And they have so much equity that even if they have bridge debt, they can just refinance anyway and not, have to sell at distress. There's institutions, and vast majority of what they do is perm debt, and a lot of it is locked in for 10 or 20 years, and they usually don't sell for in less than 10, 15 years. And then there's, places like pension funds that are holding, billions and billions of dollars of assets. So we don't have any window or visibility to that. So all we hear is gloom and doom, and we basically say, we are the industry and the industry is doomed. None of those things are even remotely true.
Yeah, thank you very much. Yeah, sharing that. And what's your take on debt fund, preferred equity points? These things are coming up, right? To save these distressed properties.
Right. So, I mean, let's assume that there's, 2,500 distressed properties. I believe that half of them fall into what I call the Jesus can't save you category, trying to get a chuckle out of people, of course. If you're religious, just close your ears. But so, so half of those are likely to go back to the bank anyway. And I don't know of any private equity group that would even consider bailing those groups out. So there's a lot of buzz around private equity. There's a lot of buzz around pref equity, right? So private equity will save us, pref equity will save us, these kinds of funds will save us. But the challenge is pref equity is only interested in investing in things that are lower risk than common equity. Well, a large number of these properties, if any investment made into them is extremely high risk because their chances of success are very low. So I think the pref equity guys will basically come in and bail out some of the people that can refinance. So it's like, I'll put in $3 million and immediately using my money, you can refinance. That's a requirement for me to put money in, and I'll do that. You refinance to perm debt. Now your investors will get no cash flow for 3, 4, 5 years, but you may be able to exit your property and pay me, right? And
Yeah.
so now you will avoid a default. Your investors will basically not lose their money, but they won't make any. And there will be a lot of properties like that. I'm going to guess that 500 to 1,000 of those properties go into this limbo mode that sticks around for 3 to 5 years, because once they refinance to perm, they're stuck with that property for 5 years. So they're basically running a large number of these. I don't want to call them deadbeat properties because often there's nothing wrong with the property itself. It's fine. It's
Yeah.
just the terms don't work, and the fixed debt that people will go into will be at 5.5%, 6%, 6.5%. So that means they don't have any way of getting out for the next 5 or 6 years. So I still think that that's a great outcome for those investors because otherwise they'd lose all of their money. So I think you'll see a large amount of that happening. But I do think that, half or more of these properties are going to go back to the bank, and that's going to cause some distress in some markets. Once again, remember 100,000 properties, 3,000 in distress is 3%. But even that 3% is spread very unevenly in the United States. So there's about 20 favorite syndicator markets, four in Texas, three or four are in, Florida. There's, Nashville and places like that, Phoenix. So when you look at how many of these 3,000 properties are in these 20 markets, it's probably 70%, 80%. So what will happen is that if there is distress, and prices go down further than they should, it'll probably just happen in that set of markets. And some of those markets, if economic conditions are booming, it may not happen either, simply because there's too much money that comes in and takes over those properties. So bottom line is that some of the booming markets are more likely to see distressed. Some of the steady Eddie markets, for example, Ohio markets, Oklahoma City markets, Kansas City, Indiana, those kinds of markets are actually not going to see much distress at all, simply because they didn't have crazy run-ups, so the cap rates paid were not, ridiculously low, and the prices were not ridiculously high. So you're going to see some distress, but I think it's going to be localized in a bunch of different markets. I think Phoenix will hurt, Austin will hurt, and a few other markets might see some pain for some amount of time. I expect that most of the pain will be gone by the end of this year. So, 2023 has been a painful year. 2024 will be a painful year. By 2025, you will have a lower interest rate and you'll have lower cap rates. So both of those should help you if you survive to 2025, which is why the word survive to 2025 is used a lot these days. Then you probably will have some options at that point in time to keep going. And even if you don't, another 500 properties will be, go to banks in 2025. 500 is a small number when you've got 100,000 properties in the country.
Yeah, thank you. Those are great points. So apart from cap rates or inflation, so what other global factors like supply demand or any other factors impacting overall distress, specifically?
They're not. So supply is actually currently helping in every way possible. So it is normal for people to give the Federal Reserve all of the credit for bringing down inflation. Inflation peaked about 20 months ago at 9.2%, roughly, or 9.1%. And today is a little bit under 3, right? So as of, last week, it's just, a shade under 3. We still want to get it down a little bit further, but it's coming down very nicely. So I have no doubt that, next month it might come down, closer to 2.5%, which is a great number. The Fed, would have loved that number if I'd asked them about, hey, what happens if you get to, 2.9 by, January 2024? They'd be like, I'll take it. I'll take it. That's amazing, right? Especially because unemployment has not increased. In all previous Fed cycles, unemployment spikes. This has not happened this time. So it's a very bizarre circumstance that unemployment has gone from 3.5% unemployment to 3.7, 3.8.
Yeah.
And so the country is staying very heavily employed. Salaries are rising. So right now we have positive wage growth, which means wage growth is higher than inflation. right? So in that scenario, people actually are, their buying power is slowly increasing, very slowly, but increasing, but it's certainly not decreasing. That's what you worry about is buying power decreasing, and that's currently not happening. So the US is in a fantastic position, and I don't see anyone being hurt by supply. What has really happened is on the one side, you had all these supply disruptions in COVID, but as prices come down, 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 as prices are dropping, everyone, all of the suppliers get into this negative mindset because they're seeing prices drop every single month. And so they become more aggressive. They become, they're quicker to cut prices. So we are seeing supply side deflation in the US economy, right? We're not seeing home prices deflate. They have actually gone up 1% in the last, 18 months. Multifamily's gone down, so rents have only deflated by about 1%, so that's not a deflation. So on the housing side, there's no deflation to speak of. So how is inflation coming down? Where is it coming down if there's no demand deflation either because unemployment has not happened? So if there's no demand inflation or demand deflation, and there's also no deflation in housing, where's the deflation coming from? It's all coming from the supply side. So it's not the Fed, it's that the supply side is adjusting. So people who are supplying stuff are making it cheaper. I mean, look at how much Tesla has cut prices of cars, 20 plus $1,000, right? So we are not seeing any disruptions in the supply chain. In fact, today they're very helpful to where we are and are one of the secret sauces for why inflation is coming down even without a change in unemployment. And I don't expect that to change. I don't expect there to be a lot of inflation in 2024. If anything, inflation should be lower in 2024 than it is in 2023, though we're getting to the limits of where how low it can go. So I think it bounces around in the twos where it is as of last week.
Yeah, got it. Thank you. So will we see like any recession in 2024?
A year ago, I would have bet $1,000 that there would be a recession. I would have even given people 1,000 to 1 odds. And the reason for that is I study economic cycles. 9 times since World War II, the Federal Reserve has raised rates. 8 times they've caused a recession because the raising rates creates unemployment. Rising unemployment reduces demand, less people buy stuff when they're unemployed, and that basically drives the economy into a recession. So 9 out of 8. The ninth time was really not a good example because we came this close to a recession, 1 inch away, right? So it still felt like a recession, even though it technically wasn't one. So what happened this time with unemployment refusing to budge was bizarre, was highly unusual. And until 3 or 4 months ago, I was still convinced the other shoe would drop. I was still convinced we would see rapid increases in unemployment. All of a sudden, the dam would break. No such thing has happened. So, I mean, here we are in, late January, early February in 2024. The Fed has reached its goal and is, now likely to cut in April or May. They're not going to cut in March. So we're only 3 or 4 months away from the rate cutting process, right? So when you're only 3 or 4 months away from the rate cutting process, you're going to lose some employment. I'm not saying unemployment is going to stay at 3.7. We're going to see it pick up 3.8, 3.94, 4.1, 4.2. But so what? I mean, low fours unemployment, that's normal, right? That's normal. The economy is extraordinarily high employment right now because of all the free money that we gave away in COVID that caused companies to hire. So there should be some adjustment to that. You will see unemployment rates going up in 2024. But 4.5% unemployment doesn't cause recessions. So at this point, I would say the chances of a recession in 2024 are pretty damn low. It's going to feel like a recession in Q2, Q3. There's going to be people whining. You will see job cuts, especially in tech. But, job cuts happen all the time. If the economy is producing right now, I think last month was 187,000 jobs a month. So if it's producing 80,000, you probably still have positive GDP. So that still means you can have 100,000 people lose their job every single month, and you're still okay. You're still not in a recession. You see what I mean? So I think we'll see slowdowns in everything. We will see an acceleration in rents because rents the last 12 months were flat. I mean, if you look at it on a nationwide basis, especially the high supply markets were negative for rent, the low supply markets were positive, but small positive. I do expect that rents will accelerate just a tad bit, but I expect them to be around the 2% range in 2024. So nothing sexy, nothing super interesting. I would expect some of the high supply markets to still stay at 0% rent growth for 2024. But the lack of a recession would put a floor under not just the selling prices of properties, but also rents reducing.
Yeah. So even ADI also predicting like 2 or 2.5% rent growth. Again, there are so many factors that we need to consider. Again, market to market and
Really, it's market. Yeah, rents are at this point very heavily market to market dependent
yeah.
because of ridiculous variations in supply. I have never seen in my career such variations in supply. There are literally markets where it's 10% of stock. The historical average is a market receives 2% or 3% more stock each year. So if a market's reducing 7, 8, 9, 10%, there's who the heck knows how that market's going to react in terms of price cutting.
Yeah, sure. Sure. And Fed is planning to cut 3 times in 2024, but the market is pricing like more than 3 cuts. So what's your opinion on that?
I think they're both wrong. The market is pricing 6 cuts. I think that's ridiculous. Wall Street is always overly bullish. The Fed is pricing in three, but keep in mind that if you look at the Fed's historical record, when they price in three, they cut four. So they are naturally trying to make sure that the stock market doesn't do what it did in the last 30 days. The stock market just hit a new high. The Fed is trying to prevent that. And one of the best ways to prevent that is to be very bearish in their statements. So I don't think that they'll cut 3 times, but I think the right number is just above where the Fed is saying it is. It's probably four. So my bet is a 100 basis point reduction, but I do expect that it will accelerate in 2025. I don't think it happens in 2024. So if you get 100 basis points this year, we should be happy. 150 basis points that's just typical Wall Street bullishness. I hope it happens. It's good for me. I'm just not going to take any actions thinking that it'll happen.
Yeah, thank you. So, and like from asset management point of view, need so what strategies investors need to implement to mitigate like impact of escalating material cost or supply renovation costs or labor costs, other expenses impacting overall NOI.
I'll give it to you by quarter, right? So Q1, Q2, Q3, Q4. I think in Q1, you need to be looking at the cost of stuff that you're buying because that is under pressure right now. So everyone that's selling stuff is under pressure to cut prices at this point in time, so it's easier to squeeze them. Labor is under no pressure at this point in time. As I mentioned last month, we produced almost 200,000 jobs. Wage growth is higher than inflation, so it's positive wage growth. So there's just not a lot of things that you can do on the payroll side. So I suggest that in Q1, you focus on pushing down prices of things, supply, right? Windows, if you're buying them, roofs, if you're buying them. So that's where you can get, significant benefit. And then other sort of programs that create supplementary revenue, whether it's renters insurance or those kinds of things. Don't raise your rents, but raise your fees. I think that it's better for you to raise your fees than to raise your rents at this point in time, or maybe raise your rents less than you're thinking. So that buys you occupancy. Don't be very aggressive. 2024 is not a year to make money. 2024 is a year to get through. So if you're a inexperienced syndicator, you could be very aggressive in trying to gain occupancy and basically end up with big rent cuts, or you might end up with occupancy in the 80s, right? If you're trying to push rents too much. So I think this is a year of balance. You really got to be careful and cautious. A lot of people have said this is the year of the operator, and I really agree with that. Now in Q3 and Q4, that's where I think you push on payroll because that job growth number, if you just track it, and there's lots of free sites that track it month after month, you notice that the number of jobs that are the economy is producing is coming down. It's not a straight line, but it's generally coming down. And I expect it to come down in Q1, and I expect it to come down again in Q2. So by Q3, the economy might be producing less than 100,000 jobs, right? And that's when it starts to feel for employees that there's not a lot of good options, and that's when you push down on payroll.
Thank you. From loaning financing point of view, so how exactly we can position bridge loans versus agency loans for value-add deals versus new construction loans?
Right now, bridge doesn't make any sense, but I expect that what will happen is that each month that goes by, bridge will make more sense, right? So there's just no bridge math that I'm aware of that really works. There are obviously a few exceptions to that rule that are sort of weird exceptions, but in general, if you look at 100 properties, you'd probably go in with fixed debt in 90+%. You also have to prepare your audience to go back to bridge. They're afraid of it, even though it may be the right thing to do. So I expect that bridge will make a comeback in Q3, and you'll start to see more bridge in Q4. But to really, really see bridge come back, you really have to get into 2025. So this is still a year for either assumptions or fixed loans.
Any thoughts on like affordability programs,
There's a few. I think that people are in the past have stayed away from those because it's harder to sell properties that have affordable units. But I encourage anyone that is at any risk of losing their property to go that route, right? Because it's much better to end up, with affordable housing grants and things like that and deal with the challenges of that than to lose your property. So this is the year of the operator, and affordable housing is one of your options. I'd be calling the city.
Yeah, sure. And any thoughts on opportunity zones, opportunities?
I don't think so for the moment. I don't think opportunity zones are an opportunity. I think that new construction at this point of time is only for those that are very skilled at it. And just, I can tell you, I'm quite skilled at it. And guess what I'm doing? Completely freezing my projects, getting them to shovel ready, and then freezing them there, right? I don't want to take on debt at these numbers. So a lot of the people that know what they're doing is actually freezing projects. So if you're new, you haven't done a bunch of opportunity zone projects, this may not be the best time to do it. Now, if you're, far down the line, that's different. If you started construction, if you've gotten your loan, that's different. Obviously, at this point, hang on for dear life because it's going to be very challenging.
So any thoughts on any preference over like new construction, new development versus, class A or A minus properties from buying point of view?
So, if funnily enough, I do a lot of new construction. I do more new construction than value add, but my honest answer is this is a great time to be buying value adds. It is not a great time to be doing new construction. It is an incredibly fantastic time to be buying land. You see what I mean? So what happens is new construction is basically hurt by the fact that interest rates are very high and LTCs in that world we use loan to cost instead of loan to value are down. So with low LTC, high construction costs, you're using a massive amount of equity. That equity is not really available. So you start using mezzanine equity, which has its own problems. So lots of issues there. So I would not encourage anyone to go into new construction at this point in time. Land, if you can squat on it, is brilliant. So I have an army of people, a large team, 4 full-time employees just squatting on land. Now you might say, what the hell is this squatting on land business? Squatting on land is as follows. You make a bunch of offers, we make 5 a day, 4 a day, and you buy yourself the 21-month magic. The 21-month magic only works in distressed times like now. The 21-month magic is as follows. You get 6 months of investigation during which you put down, 2% deposit. Then you get 12 months of governmental approvals. And even at the 18-month point, if the government hasn't given you approval for what it is that you're trying to do with that piece of land, you walk away. Your deposit never goes hard if you know what you're doing. And then you get 3 months of paid non-refundable extensions. So I could basically not close on my land for 21 months today. Guess what that 21-month number was 2 years ago? 4 months.
Yeah.
Right? So I had 4 months 2 years ago to close on land. Today I have 21 months. In other words, I am squatting on someone else's land for 21 months without paying them. Okay? Land squatting is a brilliant strategy right now. I'm offering 50% off. I'm not really able to get 50% off, but what's cool is if I offered even 20% off 2 years ago, they would laugh at me, right? They wouldn't even respond. Now, when I offer 50% off, I get a response from them laughing at me gently and suggesting that I need to go up. So I get a response. So what I do is I then respond with a 40% off. And sometimes that gets accepted. I have had 40% off accepted. And sometimes they come back to me and they basically tell me what I have to do to close, which is usually 30 to 35% off, right? But even at 35% off, I'm just putting 2% or 2.5% deposit. The highest deposit I've put in is 3%. And so then I'm land squatting. So that gives me 21 months for interest to come down before I, need to go shovel ready. So land squatting is great. Construction bad. Value add great. I think you just have to convince your investors.
Thank you. Thank you for sharing that. So any other market shifts or any other trends overall impacting value add or, land development opportunities?
Not at this point of time. I think the market is a little bit frozen. There's, a little bit shell shocked. I'm seeing the office market continue to go through its extraordinary meltdown, and there's a big difference there. A lot of people are like, multifamily distress, office distress. No, Multifamily distress, office distress, like this size. I mean, it's just massive, right? You're talking about numbers that are massively, massively, massively larger because their occupancy has fallen from, almost 90% to, well below 80%. So that, it's nationwide, it's fallen 12%. San Francisco's fallen 20 plus percent. So, at that point, the whole industry is unviable. I'm not saying every building is unviable. Actually, there's a lot of Class A's that are doing just fine, but a lot of Class B's, a lot of Class C is unviable. So we're talking double-digit percentage of the office industry that has become completely unviable, and there's no exit for them. So one of the trends that you'll see is you'll see very heavy price reductions come Q2, Q3, Q4, and that'll continue for a while. It'll continue into 2025. I expect that the multifamily discounts are going to be reduced by early 2025, but office discounts may actually peak somewhere in 2025 or even 2026.
So how are the demographic shift also impacting overall demand for apartments?
Well, it's reducing it. I mean, as apartment people, we love to say, 4.7 million units. That's a common number, I think, comes from Freddie Mac or Fannie Mae, and many other numbers are similar to that 4.7 million shortage number. What apartment people don't say, which shame on them, is that that 4 million number is a combination of, some people use that 4.5, 4.7 million number for like immediate window. Well, then it's a combination of single family and multifamily, right? And if you're talking about that number that a couple of people have said, we need 4.7 million apartments by 2035.
Yeah.
Okay, fine. But it's 2024. So we have 11 years for 4.7 million apartments. Doesn't that mean we only need 400,000 or 410,000 apartments per year? Shouldn't you be asking how many apartments we produced in 2023? More than 410,000. So at this point, construction is actually keeping up with our needs. So this concept of somehow we need a gigantic number of apartments, and if we don't get them, we will all make, humongous amount of money. It's not true. It's just typical bravado from the industry throwing out a number. I throw out that number too, by the way, but I explain to people that there are windows of opportunity in there, right? So if we need 410, 420,000 apartments a year and we're making 350, there's a break there. But to imply that we are somehow ridiculously far behind and we will never catch up is not true. On the single family side, we're producing 1 million new units a year, right? So I just feel very hesitant to say that this 4.7 million person need will be there in 2030. Why? Because our demographics are slowing. So the United States is basically now growing at 0.5. Now we had a really bad year with COVID because of all the people that died.
Yeah.
But our growth rate right now is 0.5%, right? Well, that is less than half of what it used to be 15 years ago. So if your growth rate is 0.5%, then your family creation, your household creation is not going to be more than 0.5%, right? So technically, you only need 0.5% stock a year, and we're producing more than that. Now, there's other factors at play here because what's happening is, single family homes are staying so expensive that in the past, 2/3 of Americans would live in their own home and 1/3 would rent. Well, that number is likely to change over the next 10 years, and the percentage of renters will go from 1/3 to more like 40%, maybe even 45%. So there's some tailwinds there, but I don't think that demographics is helping us at this point. It certainly won't help us for the next 10 years. And I expect that by 2030 or 2035, we will actually have an equilibrium market. And an equilibrium market is one where you get, 2% rent growth every year connected back to inflation. You don't get any cap rate compression or decompression. Cap rates basically stick around the same place for 10 years. That's normal. If you study the last 80 years, you'll notice that this amazing cap rate compression, a lot of it has really come since 2001. Things don't stay out of whack forever.
So lastly, can you share us your data-backed insights and bold predictions for where interest rates, inflation, and cap rates will settle in next 18 months?
Sure. I think today a multifamily fixed debt is, in between 5.5% and 6%, depending upon the asset and location. I expect that to be 75 basis points lower 1 year from today, right? So, just look at that, and that range will be 75 to 100 basis points lower. I do expect there to be more availability of bridge. So I think that's where we'll get most of our benefit, not necessarily from the interest rates. Cap rates in the United States, People calculate cap rates in so many different ways, and they're so tied to regional markets. So I'll say national cap rates in the United States, when you look at everything, now are up by at least 125 basis points or 1.25%. I expect them to go down by basically 50 to 60 basis points in the next 18 months, not in the next 12 months. To next 12 months, it might be half of that 60 basis points. So they might, go down by 30 basis points. So not a big swing, but then they should go down by another 30 or 40 basis point. So the next, 18 months, and then they'll continue to compress from there. Because once we start getting back to interest rates in the low fours, you get a lot of cap rate compression.
Can we expect more discounts in 2024? Maybe property values went up. Again, it's market to market specific, right? So
I'll speculate that prices will go down 5% below where they are today, but there's a bottom, and that bottom is the point where the Fed starts to cut rates. That starts to create a bottom under prices, and we're only either 3 months or 4 months, likely 4 months away from that point. So we might see another 5% drop, and then we keep that drop. Let's say they drop 5% by April, and they sort of hang around there for another 4, 5, 6 months. So that's the quote unquote bottom. And then you might start to see a decrease in cap rates or an increase in prices in some markets in Q4, other markets in Q1, other markets in Q2.
yeah, thank you. So any other market shifts or any other market trends we can see in next 12 to 18 months?
No, I think you had a lot of great questions. I think we covered all of it.
Yeah, thank you. So any recent good books that changed your perspective or thinking?
Traction. I think Traction is a book that essentially is about how to run your company better. A lot of syndication companies are maturing now. They've been around for 3, 4, 5, 6 years. And so it's time to really look at your organization and how to grow your organization. People are like, it's not a good time for growth. Well, there is no good time for growth. I mean, Microsoft and Apple were started in garages during recessions. You don't have a recession right now. Unemployment's at 3.7%. So why is it not a good time to grow? I think these are actually good time to grow. We're going to lose a lot of syndicators in the next year and a half, because people realize that there's no short-term money in multifamily anymore. It's a long-term, painful process. Many people were short-term driven and will get out. So I think Traction helps you with growing your company.
Awesome, thank you. So any other habits helping you to be successful or keep you motivated?
Well, there's a book called Miracle Morning. I really enjoy it, and I have adopted pretty much all of the stuff that's in there. One of the things that I do that's a life hack that I enjoy telling people about is I'm Indian, and I know that medical services in India are very high class, but are also extremely inexpensive. So I pay a company in India $12 a day for online video physiotherapy sessions with a doctor of physiotherapy. I'm 50 years old. By the time you're 50, you have lots and lots of muscles in your body that are messed up. And so basically, I pay them all year round to fix one muscle at a time. And that has made a massive and dramatic change in the way I think, because your body affects your mind and it affects it tremendously. So as we get older, especially when we have muscle issues or knee issues or hip issues, we owe it to our investors to be the best that we can be. So paying $12 for a session and doing 250 sessions a year is my favorite hack.
Awesome, thank you. Thank you very much for sharing that, Neal. So how exactly listeners can connect with you?
We have a website called multifamilyu.com. That's multifamily with the letter U after it.com. 20,000 people register for our events. Our biggest event is actually coming up. It's, late January, early February, where we talk about, the markets that we think are going to do the best and the markets that are going to be the most dangerous. We talk about the top 5 or 6 trends that we see in the marketplace, and that is coming up. But we do events throughout the year. There's no subscription, there's no upsell, there's no paid product. We don't sell education of any kind, and we have no intention of doing that. It's just a community of people that come together and enjoy high quality content. We spend a minute in every presentation showing them our latest project. So maybe if they're interested, they can jump into that. Otherwise, it's just high quality content. So I strongly encourage people to look at multifamilyu.com.
Awesome. And thank you very much, Neal, again. Thank you for sharing your perspective on different aspects of multifamily investing and also macroeconomics, microeconomics. Thank you very much.
Thanks for having me on again, Rama. Be back soon.
Sure.